In case you have a million Kenya shillings, where will you invest this money? Will you invest it in the money market funds, MMF, or will you invest it in dividend stocks? Or even will you invest it in other alternative investments? Comment down below. I want to know where will you invest this money, even as I do the analysis in this video. You are all much welcome to my channel. My name is Afagza Sifuna. In case you are new here, kindly consider subscribing to this channel. Subscribe. Down below there's a button called subscribe. And also while you still at it, drop a like on this video so that I know you are enjoying this amazing content I'm giving you each and every day. Having said that, before you even put your money on anything out there, the first step should always be to define your money goal. And I'm saying so because if you do not define your money goal, you're going to be walking or moving blindly. Think about it. In case you leave your house and you start walking to whatever without a goal of where you're going, chances are you'll walk, yes, you'll be very tired, you'll be very confused, and you won't make any progress. That's why you need to define your money goal first. For example, this 1 million, are you putting it into a given investment so that after 1 year, you cash it out and utilize it to pay school fees? Okay? Are you, for example, putting it in a given investment out there to hold it maybe for a few weeks or even a few months, and then you're going to remove it to buy or invest into something better or even to use it for your emergency fund? Or are you investing this money because you won't need it for the next 5 years, 10 years, you name it? Based on your desired investment horizon, basically the time you desire to invest and what your investment goal is, you'll know which investment to go with. Because all the investments out there typically have varying maturity times or varying conditions, okay? Some of these investments, you can access your money in a few hours or a few days in case you want to cash out. There are others which are even fixed, okay? And there are others for your own good. It's better you leave them there because they could be having annual terms, or even so, you can only realize benefits after investing for several years. After defining your money goals and also your horizon for how long you want to invest, then you can settle on whichever of the investments out there because each of them is different. Having said that, let's look objectively at MMFs. I'm pretty sure in case you are in Kenya, MMFs is a very big topic when it comes to investment and people thinking where they're going to put their money. But then again, you need to understand MMFs for you to even decide to put your money in MMFs. MMFs, or money market funds, are basically funds which are managed by specific fund managers out there who pull funds from different people, okay? Think about it. If you have 1,000 people giving you different amounts, some might give you 1,000 Kenya shillings, others might give you 5K, others might give you 50K. At the end, these fund managers can even have, for example, 20 million, okay, from different people, which they pull together and they invest in short-term investments because they typically prioritize things like, for example, commercial papers, T-bills, you name it. They put money in these short-term investments, and then you as an investor, in case you need to access your money back, you can access it in a very short span of time, maybe 1 day or a few days, and then you access it also by benefiting daily interest. So you benefit from daily interest when you put your money down on MMFs. But then again, of course, most MMFs out there typically advertise with a given percentage. Maybe they can say it is 10% per annum on your investment. But the reality is that the actual percentage which you're going to get, assuming even fulfill the entire term of 1 year, is less than is actually typically less than that percentage which they put out there. Reason being, remember, you are giving your money to a given fund manager. They also have management fees. They have transaction fees and other fees which they charge and impose those fees on you by assisting you invest your money. But at the end of the day, typically you get something small on top. So if you have money, for example, which you want to access in a short span of time, maybe you want to utilize it for emergency in the coming few weeks, in the coming few months, probably MMF is a good thing for you because MMF is typically classified under liquidity buffer, kind of like holding of money or even investment. And that is an option for you in case that's the area of interest or goal for which you are investing. Okay? And then let's now look at now the second alternative, which is dividend stocks. I'd really encourage you to jump on dividend stocks in case your investment horizon is, for example, a year plus. If it's 5 years, that's fair enough. And I'm saying so because now when you look at dividend stocks, that is where the real upside of investing in the stock market is. Because typically, when you are investing in the stock market, you typically only have two ways of seeing your investment improve or increase in value. It's either through share appreciation, where a share price goes up. When you buy, the share will increase, okay? And then the second way is through you enjoying dividends, which basically mean a company has done business, okay? At the end of the year, maybe the business has been good, it has gotten some profit. The company decision makers might decide they want to share that profit with you. And that is why they could allocate a given percentage of their profit to share it with you in form of dividend. Basically telling you, thank you for trusting us with your money. You being part of our company, we want to share percentage of our profit with you. Case in point, if for example, you buy a share of a given company at 15 shilling, okay? Come the end of the year, the company decides they are going to pay maybe 1 shilling 50 cents, okay, of the dividend per share, which they're going to declare, whether it is interim, final, or total dividend, whichever the case is. Let's assume it's total dividend. They are paying you 1 shilling 50 cents for you investing 15 shilling per share. That is going to tell you, assuming the 15 shilling per share was the average share price for the year, then it means your dividend, we're talking about your dividend yield is going to be 10% because 1.5 shilling or 15 shilling is 10%, which of course is an amazing percentage. And where it gets juicier is that in case you plow back this dividend back into your stock investment, it means you're going to keep enjoying the benefit of compounding. Basically, you putting money in a given investment, not cashing it out, instead returning the annual returns back to the investment. You do that multiple times over years, you're going to see your principal or initial capital grow big time. And that is how a good number of rich people out there have made money through investing in dividend stocks. So if your time horizon is, for example, multi-years, okay, you are not in a rush to deal with the sentiments of the market. Basically, you are not thriving on fear, anxiety, etc. You can look at, analyze, understand which are the best dividend stocks in the market, and then put your money down on those dividend stocks. But of course, there is multiple things you need to look at when you're putting money down on dividend stocks. For example, what is their dividend? Okay, what is their dividend yield? Okay, what is even their payout ratio? Basically, what portion of the profit are they committing to paying dividends? Okay, you can even look at, for example, what is their debt situation, right? You can look at, for example, their historical performance of shares. Because if, for example, a share recently took a dip and then the dividend yield is maybe claimed to be 10%, what does it mean? Maybe that's a reflection of the dip or crash in the market shortly before declaring the dividend. So look at all these nuances, more so historically, to have a sense of the company health before you commit your money to a given dividend stock. But then again, all said and done, I strongly believe there is more upside potential in investing in healthy, good dividend stocks compared to even you chasing share appreciation. Because share appreciation, you're basically monitoring stocks regularly because you're banking on that. But on dividend stock investing, we're talking about you sitting back, relaxing, knowing very well this company is in good health. They have proven to pay dividend before, so most likely they're going to pay dividends. And the amazing thing is that in the Kenya investment stock market, which is basically Nairobi Securities Exchange, we are talking about most of the companies they are being mature. Mature in business, having distinct competitive advantage, which basically mean most likely, please note, I'm not saying certainly, I'm saying most likely they're gonna pay dividends year in, year out. And even looking at the numbers from, for example, 2025, basically last year's full dividend which was paid out, some companies, like for example, Standard Chartered Bank, okay, some companies, like for example, BAT, even had dividend yield upwards of 14%. That is how amazing it is. But of course, on average, we are talking about dividend yields typically being somewhere between 5% to 8%. So choose wisely whether you want MMF or dividend stock investing. And a bonus for you, what if also you consider other investments, like for example, the treasury bills and treasury bonds? And I'm saying so because 1 million Kenya shilling is a substantial amount of money. And it meets the qualification of you qualifying to put your money down on T-bills or even T-bonds. The only difference is that T-bills mature in a short span of time, maybe 91 days, 182 days, maybe 1 year. Typically, treasury bonds are typically upwards of 2 years, and they are anchored on a given maybe condition. Like, for example, government borrowing to finance a given infrastructure or a given development. Okay. And they are typically multi-years to maturity. In case you decide to cash out, you lose on your coupon. So it's typically multi-years to maturity for you to be able to enjoy any interests tied to given treasury bonds out there. Either way, depending on investment threshold or investment horizon, you could decide to put your money on T-bills or T-bonds. And these are also accessible investments to Kenyans out there. Capitalize on these in case you want to invest your money through government securities. The only difference between government securities, MMFs, and even dividend stock is that the default risk in you investing in government securities is close to nil, because government is the biggest spender in any economy and also is the one which dictates tax conditions in any economy. By them borrowing the money from you, it basically means they are almost certain they're gonna pay you. In case they are, for example, they have a cash crunch, they'll still find a way of raising the money to pay you, whether it's through taxes or whichever other means out there. That is why some investors out there do favor putting their money on government securities, treasury bills, and treasury bonds because of the low, close to zero, negligible default risk. Guys, what do you think about this video? In case you have 1 million, based on what I've shared with you today, which investment will you prioritize to put your money down on? Comment down below. In case there are other alternative investments out there, which ones will you go for? Having said all that, personally, depending on time horizon, that is what is going to be anchoring my investment, because all these investments are amazing. Case in point, T-bills, T-bonds, we're talking about typically having a percentage return upwards of 12%. Okay? MMFs typically have somewhere between 8% to 11%. Of course, it varies depending on interest rates and other factors. Okay? And then we're talking about these other dividend stocks typically having a return of somewhere between average of 5% to 8%. All these are amazing possible investments because you're going to get something on top. It just depends on what your money goal is and what your time horizon looks like. And then you can decide to go with whichever of these investments. I wouldn't say go for a specific one. I'd say do that based on your own interest, on your own investment priority, and on your own investment goal. Because I'm just sharing with you these ideas, this is not financial advice. You need to do your own research. Your risk varies, your appetite varies. That's why I'm saying it depends on you. But I believe this knowledge is amazing for you to absorb so as to be informed when you are making that decision. Thanks a lot for watching this video. I look forward to share with you other amazing videos next time. Cheers, guys, and you all take care.